This is no longer just a rate cut in Canada. The Bank of Canada has quietly begun expanding their balance sheet behind the scenes. The proof is right here in a report they posted back in January of 2025. This is actual proof that they're flooding the system with liquidity again. And when the banks expand their balance sheets, it is no longer stimulative for the average household. In fact, it is stimulative for capital markets and those that own assets. Even when we look at the balance sheet over the last 5 years, it has never truly come down to pre-COVID levels. You can see the balance sheet has barely come down, and yet the bank has just begun expanding it yet again. This means more liquidity, more credit supply, and more pressure on the Canadian dollar. The sad thing is, in Canada, this extra liquidity no longer flows into productive measures. In fact, now in Canada, a good chunk of this liquidity flows into housing. And every tick up on this chart is another twist in the screw of affordability for the average consumer. In this video, I'll break down how the balance sheet expansion flows directly in mortgage credit, why it financializes housing instead of fixing the real economy, and what this means for housing prices in the future. And trust me, if you think this balance sheet chart is explosive, just wait till you see the impact all of this has on housing prices. What really is balance sheet expansion? Well, balance sheet expansion is when central banks begin buying government debt in the forms of bonds and treasuries. This allows the central banks to hold the bonds and treasuries on their balance sheet as assets to fund their liabilities, aka inject new money into the system. Except the thing is, with Canada, mortgages have been securitized, and so now when the central bank begins expanding its balance sheet, mortgages now get wrapped up in government bonds and in turn are bought up by the central bank. So what this does is it crowds out private investors and forces them into other fixed incomes like mortgage-backed securities, or down the risk curve into equities and other things. With the Bank of Canada beginning to expand its balance sheet yet again, we have to understand that this is right on cue for a global trend of rising liquidity. And the thing with rising liquidity regimes is that funding costs for investors begin to cheapen. What this chart breaks down is the Government of Canada 5-year benchmark yield for its bonds with the 5-year fixed mortgage rate. And now, as the yields come down on the bonds, that is the signal of higher liquidity regimes, which in turn compress the spreads between the bond and the mortgage rate. And so, long story short, in high liquidity regimes, it becomes much cheaper for investors and traders to finance real estate trades that outperform holding a government bond. So if you thought the housing market was competitive just in your neighborhood, imagine a bunch of hedge funds and traders coming in because real estate just got cheaper to finance, and now you have to bid with them, alongside them, in order to acquire a house to live in while they're seeking to acquire a house to profit from and to later probably flip. 10 times out of 10, the single mom wanting to buy a house will be outbid by the hedge fund, by the trader. Another thing we need to understand in these high liquidity regimes is that currency is being debased throughout this regime. And so when housing is priced in fiat, in Canadian dollars, when we see the price go up, is real estate really getting expensive, or is the value of the currency decreasing in real time? This is one of my favorite channels of increasing housing prices to discuss, because so many people have a hard time wrapping their mind around it. And when I tell them housing has become cheaper when priced in Bitcoin over the years, they absolutely lose it. But what this chart shows is Canadian housing prices over the last 5 years priced in Bitcoin, and it's done exactly that. It has gotten cheaper. In fact, it now costs about 2 to 3 Bitcoin to buy a house, instead of 600,000 Canadian dollars. What this shows us is that when you price real estate in the purest, hardest money we have as a society, things actually get cheaper. But when you price it in garbage fiat, well, guess what? It will get more expensive over time. And now finally, the next channel for increasing housing prices is obviously the bank's balance sheet. Here we have the balance sheet overlaid with housing prices, and the correlation is stark. Especially in 2020. There was a bit of a lag effect, however, prices did catch on. And we also have a bit of a dislocation happening around 2022, which needs to be studied. But here, this shows us that real estate no longer acts as a payable good. It is in fact being turned into a liquidity sensitive asset for hedge funds, for traders, to be used as a hedge against this currency debasement. And what that does is it prices my generation, the generations that come below me, and even the generation before me, out of owning a home and out of starting a family and moving on with their life. Bank of Canada's balance sheet expansion is no longer just a bond market story. This in fact flows deeply into mortgage credit and housing insulation. Through funding compression, currency debasement, and liquidity plumbing, housing in Canada continues to behave like a financial asset and not like a payable good. That's why in a world of high leverage and rate cuts, the structural bid on housing still exists. Now, if you guys enjoyed this video, drop a comment down below. Make sure to hit that like button. And as always, make sure you subscribe. Catch you guys in the next video.